Okay, so today is tax day here in the United States. It's 1 p.m. in New York City. So good afternoon to you all. I'm sure we have attendees from all over the planet. That is why I love these webinars, because it gives me a time and opportunity to meet people from different countries and discuss Forex with them. Today we had a lot of market moving events in the Forex market. It all started with the ECB, ECB's head Mario Draghi being attacked during his conference, which was pretty interesting. A woman jumped on his desk and shouted, stop the ECB dictatorship, which was pretty interesting. But nonetheless, even with the attacks, the ECB went ahead and decided that they are going to stick to their loose monetary policy system, and they're not going to change their interest rates. And that is why we saw a fall in the European currency, the single currency of the European Union. But at the same time, we had some good news out of the US. We had stocks rallying. And that is why the stocks rallied actually after several strong earnings report. And if you're looking at the euro dollar, actually we saw a jump because the US dollar rally was stronger than the European currencies fall. So that's why the euro dollar pair actually jumped up. In other news, I'm just trying to wait for everybody to come in. We're having more and more attendees joining us today. Welcome Bob, Callan, Carlos, Dave, John, Michael, Michelle, Maria, Muhammad, everyone. Thank you so much for joining us. Can you please type in a Y for yes if you can hear me here in the chat box on the right-hand widget, so that we can have. Yes, thank you, Kelly, thank you, John, thank you everybody for responding. So as I was saying, we're waiting a little bit more for other attendees to attend, but another news that we had today that did move the market was oil productions in the U.S. that jumped, even though the drilling in the U.S. has been collapsing. I have actually recently published a very thorough oil prices outlook on investiva.com and what we should be expecting. And the reason why oil is important for us Forex trader is because the oil prices are inversely correlated with the U.S. dollar pricing. And as you know, the U.S. dollar has become stronger and stronger. And therefore, one of the reasons why is that the oil prices are going lower. And we have a few bearish signals for oil prices. One of them is strength of U.S. dollar. Another one is a possibility of Iranian oil entering the market after their sanctions are lifted. Well, we had a treaty with the U.S. Obama had this conversation last week with them. And if that happens, we can see even more drops in oil prices, which means more strength for the U.S. dollar. Another bearish signal is actually approaching storage capacity in the U.S. So that is a big problem over here. But they're looking into fixing that. So oil prices may actually range between $45 to $65 for 2015, well into 2016, and therefore we can see the U.S. dollar strength continuing. So that is for that. Another update that we had today that moved the markets was Canada's Bank of Canada. They unveiled a $280 million deal to supply uranium fuel to India. And on that news, we had a massive strength and rally in the Canadian dollar. So that is how I actually was in a bearish position in the dollar CAD. And we did make money. I'm going to show it to you later after we are well and done with our Fibonacci retracement studies. So yes, today you are in the right webinar. Today we are going to talk about Fibonacci retracements. I'm going to take a few moments to introduce myself for those of you who are joining us for the first time. And then we're going to go through some very basic Forex market introductions and common terms. Again, for those of you who are new here, and we want everybody to be able to follow us throughout the webinar. And the focus of our webinar today is going to be Fibonacci retracement, which is one of my most favorite tools in technical analysis. Okay, so first and foremost, please grab a pen and paper to make notes during our webinar. Or if you are using a Windows Surface, as I am as well, you can use your notebook over there. It's pretty good. I do recommend everybody to buy one. Obviously, if we can buy it with the money that you make in the Forex market, right? Second, and all of you who are here, I'm assuming that you heard about this webinar from Orbex. I do recommend that all of you keep up to date with Orbex Trader Library. They have amazing trading tips, analysis, videos, which is actually done by myself, education that is also done by myself. So for those of you who want more education every day, which I definitely recommend, go on and log into Orbex Trader Library on a daily basis. As for myself and the reason why you should be listening to me, I am a former electrical engineer. I studied electrical engineering in Japan. I stayed there for 7 years, and that is when I actually got introduced to Forex trading by a woman trader, and I started making money, became very interested in it, and I basically came to New York City so that oh, okay, so I'm getting Michelle is saying the sound quality is very poor. Michelle, can you hear me properly now, or? Everybody else having difficulties? There. Okay. All right. I'm hoping still good. All right. Okay. Thank you, John. So as I was saying, I am a full-time Forex trader right now. I have given up electrical engineering to Forex trading, and in the meantime, I also educate students and traders around the world. We have daily signals and updates and all that. And I just want to encourage all of you to be educated and definitely continue in the road of Forex while being educated and while being a risk averse. I do want to put in a risk disclaimer that Forex market is a risky market, as is any other type of investing, and you have to be pretty cautious, especially when you enter a market with high leverage. Definitely do your education and do not trade the money that you cannot basically get to lose, because not only it's not good to lose the money that you cannot afford to lose, it also psychologically affects your brain, and you end up making a bad trading decision, because most of the poor trading decisions come out of greed and fear. And I probably am going to have a webinar on greed and fear in the Forex market, but just as a disclaimer over here, definitely be cautious with what kind of money you put in the Forex market and what type of decision you make. So what is Forex? How many of you guys know what Forex is? Let's see if we actually have to go over there. Okay, I guess I'm going to do a little intro. So Forex is the largest market in the world. It is 24/7, only 7 major currencies to follow. That is why I prefer it to stock trading, where there are thousands and thousands of stocks that you have to follow. It never stops. It starts Sunday night in New York time. That is when the Asian session begins. And it stops Friday at 4 p.m. when New York stock market closes. So basically, you can trade any time of the day, at night, during your sleepless nights, during your work hours. It offers you a lot of opportunity to trade. And the good thing about the Forex market, especially if you're trading the majors, is that it will never fully crash. Crashing meaning it's not going to go out of, like, it's not going to go bankrupt. Like even the euro, if it does go bankrupt, we still can see some kind of a cycle in the market because the euro did start at a specific pricing, right? So it is so deep. What I'm trying to say is that $4 trillion worth of transaction every day makes it such a big and deep market that anybody can basically get in, make money, and get out. And your movement wouldn't affect the currency market as much as a trader sentiment would affect a stock market, for example, because the biggest players are actually the government. And as long as you are on top of the news and you are on top of the technical analysis that we are going to cover right now, you should be good to go. Another thing that I briefly mentioned is the high leverage that the Forex market offers. It is a good and a bad thing. The good is that if you are in a winning position, it's fantastic. You can multiply your profit by however many times leverage you have chosen for your trade. In some countries, you can even have a 500-time leverage, which can also be very risky because if you are in a losing trade, God forbid, you will wipe out your account basically. So you can use leverage. You have the opportunity of using it in very high amounts, but that is at your own cost, and you must be very cautious about it. So that is why we are all here. How to make money in Forex. You make money the same way you make money in any other kind of investing or online even market and financial instrument. You make money on the way up, but the good news is that you can also make money on the way down. So I'm going to highlight this over here. So basically, let's say you get into the market over here. You head bump into the resistance level. What we call a resistance is a barrier, a level, a key level that has been historically preventing a currency pair or any other kind of instrument to move higher up. So let's say you got into the market over here, you get out of the resistance, you make money. Another way of making money is you get into the market at the resistance level, you identify a support. This is another barrier that is historically known to be, the reason why they call it support is because in the stock market, you don't want basically the market to fall down. So if this level is supporting, is preventing the prices to fall below, that is why we call it support. So if you identify your support levels and your resistance levels perfectly or nicely, you have a good chance of exiting the market at the exact right time and entering the market in the exact right time. So the important thing that you have to remember about Forex trading or any other kind of instrument is that not only getting into the market is an important strategy, but getting out of the market, exiting the market is as important, because if you get into the market at the right time, but do not get out of the market at the right time, if you are in the market for too long or too short or are impatient or too patient, that is going to basically affect your outcome of trading. So that is why these support and resistance levels are very, very important. And this brings us to our topic of the day, which is Fibonacci trading, that basically allows us to identify supports and resistance levels. So a little bit more about technical analysis. Technical analysis is done on charts. So for a currency pair chart, I have the example over here is the euro-dollar chart of many years ago when the euro-dollar was still in the 157 and 161 area. Today, the price is obviously a lot lower. It's around the 1.04, 1.06 area. But the point is that we use technical analysis on charts, and most recently, the charts are best to be used at a candlestick chart. And a candlestick chart was developed by the Japanese a long time ago. And we have a question over here. I think you can see my okay, so your question, John, I can see your question. While we can trade 24/7, is there an optimum time in terms of high or low volatility? Great question. Yes, absolutely. High and low volatility, basically, high volatility usually occurs during the change of the trading sessions. As you know, the Forex market is global, and every country's economy can affect the Forex market. So, for example, when the Japanese session, when the Asian session begins, let's say at GMT 05, I'm guessing, that is when the Japanese, the Nikkei stock market, and the Chinese stock market, and the Australian and New Zealand stock markets are open, and they are sending out their statements and data. So that is a high volatility time for those currencies, for Aussie dollar, for Kiwi dollar, for Japanese yen, and the Chinese yuan, right? And then as you move into the London session, the European session, that is when the ECB, the Bank of England, and the Swiss banks, and all the important economic movements are on in the European area, in the euro area, in the eurozone, and that is a high volatility time for euro traders, for example, right? And then you move on to the US dollar when the New York stock market opens at 9 a.m. Eastern time, and that is a high volatility for all majors across. But another volatility point, so if I do, or Colin, I do see your question, what period you use for Ichimoku. So that is basically depending on what kind of a time frame you're using and what time frames you should be using. We have covered in previous webinars. It strongly depends on your own preferences and your own personality. Some people are great under risk and under pressure, so a 4-hour chart, a 1-hour chart, or even a 30-minute chart is good for them and it works for them. But for myself, for example, I perform best on a 4-hour chart and a daily chart. Why? Because I am more patient. I do want to have time to do other things because I do run a company. I am writing another book, and I have other things that on my plate that I cannot be glued to my trading platform at all times. So I place a trade on a 4-hour chart or on a that is funny, Callie. So if you're not patient, then definitely a 1-hour chart is good for you. So yeah, as I was saying, it really depends on. So volatility, John, I'm going to go back to you, is good for somebody who's not patient and who wants to be glued to their screen at all times. Those are the people who can perform well under volatility trading. But for me, for example, I actually try to avoid volatility. And I basically expand my stop and limit orders during volatility, during the times that I know something important and news is coming out of a country. For example, today we had the Canadian dollar. The Bank of Canada had a statement, so I loosened up my stop and limit. Nonetheless, I did make money over it, but it wasn't because I was jumping on it wasn't because I was jumping on the volatility. It was just because I was patient and I had waited for this moment to arrive since 2 weeks ago. I actually entered that market 2 weeks ago predicting that's going to happen. And actually, that was based on the Fibonacci retracement trading. So next, okay, I guess I did. So that is the reason why we actually do use different time frames. So I hope I answered your questions. Thank you for questions. So without further ado, I am going to introduce you to Master Fibonacci. And give me 1 second. I apologize for the pause. Okay, so here we go. So Mr. Fibonacci, this is not the actual photo and image that we have from Mr. Fibonacci. And actually, just so you know, the guy's name wasn't even Fibonacci. The actual name of who became to get known as Mr. Fibonacci was Leonardo Pisano Bigolo. He's an Italian dude. Do we have any Italians in the house today? That is going to help us with our progress. No Italians? All right. Actually, I do have a bunch of Italian friends. So Leonardo Pisano Bigolo was actually the one who introduced decimal system to the West. A lot of people don't know about that. And his technique was not introduced to the public because of trading, because obviously back then when he was born many, many years ago, Forex trading didn't even exist. But his number system did come handy later on. So what happened is Mr. Fibonacci, or Mr. Leonardo, he traveled to North Africa with his dad, and what he did is that he came up with a counting system that basically started adding numbers to one another. And he basically said 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, and so on and so forth. And he just did this game for a while. And after he was done playing this game, he suddenly noticed that when you, before actually we get there, I want to mention that this series, the series of number, actually helped us with the growth of rapid population, because you have one couple and another couple, and then you have multiplied by 2, and then each of these ones have kids, and so basically the series help us understand the rapid population. Anybody knew that? All right, I didn't think so. So what happened is that Mr. Leonardo, or Fibonacci as we call it, he basically started dividing all these numbers one after another. So he divided the previous number. For example, he divided 2, or like 3 by 2, and he got 0.6118. At the same time, he divided 5 by 3, and again he got 0.618. He divided 8 by 5, and again he got the same amount. It's not exact. It's like 0.6179 or 0.619, but when you round it up, it's 0.618. So that was very interesting. So he continued to go on, and he divided every alternate number. So for example, he divided 5 by 2, and he got what number? We have it highlighted over here, 0.382. Then he divided, what are the numbers over here? He divided 13 by 8, and again he got 0.382. And then he divided 34 by 13, and again the same amount. So then it didn't actually end over there. He started dividing every third succeeding number, and again he got the same amount for each and every of the numbers into infinity. So that was pretty interesting. So I didn't want to go very much into the technicality and the math. You don't have to know about it, but it's very interesting to know about it. What we use in Forex trading is not the numbers or these 0.161 We actually use these numbers as retracement levels. So we basically make them as a percentage, 61%, 38%, and 23%. These are the main levels, and we use it in Forex trading as support and resistance levels that we talked about before, right? So this is the important thing that you need to know, the levels, the 61%, 38%, and 23%, and there are actually more between 1 to 100. So here you can see Fibonacci on the chart. This is a line chart that I've just drawn. So let's say the prices are going up and down and up and down and up and down. So what happens is that at any given time, you can draw a Fibonacci retracement. I'm going to walk you through and how to do it later on, but you can draw a Fibonacci retracement from a lower low to a higher high and vice versa and create the retracement levels. And as you can see here, we have all the levels magically appear on your trading chart. So we have the 23%, we have the 38%, 50%, which is one of the most important ones, 61%, 76%, right? So, as I'm going to show you in a real chart later on, the idea is that the market is going to go up. You create the Fibonacci chart, and the market is going to retrace a little bit back to one of the levels. It should back up. That is in an uptrending market, right? So when you have, still we're going to focus on the uptrending market. Let's say you identified an uptrend, and this is the whatever chart that we had on top. And let me actually give you some steps. If you have your notes, this is a good time to be writing down in your notebook. So the first step that you have to do when you want to use retracement is that you have to find a trend. The longer and stronger it is, the better. All right? So here, in June 15th, 2010, I found a trend. It's a long trend. I mean, it has some zigzags going up and down, but the general view of the market in whatever time frame it is, it is a daily chart. So, and by the way, you can use Fibonacci retracement any time frame. Here, we're using a daily chart, so the trend is even longer. And the market is going down. It's a trending market going down, going down. Then you find the button labeled Fibonacci retracement on your Forex account, and you basically click on the bottom of the trend and drag your mouse all the way to the top of the trend. And you can see all the retracement. You don't have to actually calculate it. That's the beauty of it. All the retracements appear on the chart. The next step is that you wait, right? So the idea, as I said, is that the market is going to retrace back to one of the levels and should back up. So as you can see here, after we place the Fibonacci retracement, the market actually retraced back to 50% Fibonacci. And of course, I have said it before, I'm going to say it now, you always have to mix and match your trading analysis with different components. So how do you know which level is going to hold the prices, right? Here, my clue was not only this is a 50%, which is one of the strongest levels of Fibonacci, we also have two spinning tops over here. For those of you who attended my candlestick pattern webinar, you would know that a spinning top is normally an indication for indecisiveness, and oftentimes it can be a reversal signal. So if you mix it up with Ichimoku and what have you, you can actually get a better idea which level is going to hold. But the matter of the fact is, when you identify this uptrend, if it were me, after I saw this bearish sentiment coming to the market, I would actually get into the market and place a bearish order and get out of the market at either 38% or 50%. That obviously depends on the fundamental news and the political situation around the world, but one of these levels could be a very good exit strategy, right? So this was Fibonacci and uptrend. We're going to go into it a little bit more, but this was just an introduction. I wanted you to know about it. Now, as I said, similarly, you can have Fibonacci. You can use Fibonacci on a downtrend as well. Exactly as you did on an uptrend, you identify a downtrend. The stronger and longer it is, the better. You click on your Fibonacci retracement tool and drag it from the swing high to the swing low and identify the levels that have magically appeared. When you see this bullish candlestick appearing right after the trend is over here, that could be a signal for you to know that the market is probably going to retrace a little bit, right? And it could retrace at either the 38% or the 50%. For me, I would go with the 38% level because it would be a more secure, risk-averse solution. Some people would go with the 50%. If you go with the 50%, you will make money. But if you don't reach 50%, then you're going to lose money. Not that you cannot readjust your limit order and bring it back to 38, but if you don't want to be in front of your computer, a 38% limit order would be more cautious and more responsible, I would say. But as you can see, in this downtrend also, the market retraced back a little bit to 50% and went back down. If you had got into the market around here, you would have easily made a 100 pips, right? Not bad at all. So depending on your position, that 100 pips could be a massive fortune, right? So another way, actually, so now you can see that the market actually, this is the continuation of the previous chart, by the way. So we had the market going down all the way to here. It retraced back a little bit to 50%. And then it went all the way back down to even lower than that. So if you missed an opportunity over here and you saw the market is going to go back down, you can actually get into the market at 38%. You see, these are all different ways that you can use Fibonacci and make money. So you can get into the market at 38% or even over here and set your stop limit over here. So over here you would have been bullish, you would have long the pair. Over here you would have been in a bearish trade. You would have shorted the trade. So this is obviously the market actually went all the way back, all the way down, and these are all the other movements that you could make money on, but we are sticking to the Fibonacci right now. So obviously you can continue making money every single day. That is the beauty of Forex market. I do see your question, Carlos. What happens when the trend breaks down the 100% or the zero level? How many pips I have to wait? Wait for inside the Fibonacci in case of volatility. So what happens if the pair breaks below the 100 level? That is exactly what happens over here. You start another Fibonacci. The markets move on. The markets are moving all the time. So when this Fibonacci is outdated, you basically have to draw a new Fibonacci. Now your swing high is here and your swing low is actually over here. And wait for the market to move on, and you continue making money and continue analyzing every single day. It is not a one-time thing. It's not like, okay, so in November 17, 2010, this happens, so it's not going to happen ever again. No, it's going to happen always and all the time, and that is why we have FX signals, because every single day we have new signals and new identifications. When it doesn't work out this time, it might work out the next time. And every time that you do draw a Fibonacci retracement, you have to obviously combine it with other tools of analysis, as well as knowing when the volatility is going to come, what kind of announcements are going to come, and what kind of time frame you're trading, because the volatility is going to be a lot more important when you're in a shorter time frame than when you're on a longer time frame. So Bob is asking, what time frames do you use for intraday swings? As I said, because of my personality, I normally use the 4-hour and the daily charts because it gives me more time to analyze the market and reading the news and knowing what's going to come up. A lot of people for a day trade, they use a 1-hour chart, which can give you a little bit less of a time to analyze the market, but at the same time, the opportunities can be huge. So it really depends on your own personality. Thanks, Bob, for asking the question. So as I said, you can use the Fibonacci levels as support, right? And resistance. So let's talk about when you use Fibonacci levels as support. As you can see here, we have an uptrend. This happens a lot with the dollar-yen pair, by the way. You draw a Fibonacci retracement from the swing low to the swing high, and you get the 23%, 38%, 51%. So now there are ways to trade. I want to tell you one of my tricks. So I normally use the 23% as a turning point, or a pivot point. So basically, this point is going to give me the confirmation as to if the market trend has changed, if the retracement is going to hold up a little bit more, or if we're going to have a little bit more of an uptrend. So basically what I do, so let's say I draw this retracement Fibonacci on September 29th, right? I didn't know what's going to happen, right? And I labeled the 23% Fibonacci, and I know that I'm going to wait for the market to see if it actually retraces back to 107.85, which is the 23% Fibonacci. Because when would you know that the trend is over, right? You wouldn't know unless you draw the Fibonacci, and every day as it progresses, you will update it. You update it every single day, and at some point the market is retracing. But because I'm a cautious trader, I won't get into the trade right there and then. I wait for the market to actually reach the pivot point, the turning point. And even though my rewards can be less, but at least I can be more confidence with my trade, right? So once the market actually reached the pivot point, that is when I know that we could actually have and see more drops towards the next level. So what I would do is that I would get into the market around here and get out of the market around here. If it breaks below even 38%, that means that a new trend has actually been born, and you can see more drops even towards the 50%. 50% is one of the strongest levels, and it's very hard normally for the pair to break it. It depends obviously on the currency pair and the market news, but 50% normally is a very reasonable place to set your support levels. So that was my exit strategy and trading strategy. Now using these levels as support is basically when you get into a bullish trade after the market has retraced back to an uptrend, because as we said, market is an uptrend, it goes down and then it shoots back up, right? That is how the market normally moves, especially when it has a very strong trend going on in a longer term view. So as we actually did see, this chart I think is belongs to 2014. We did see the pair, dollar-yen pair, is now in about 124. So John is asking, is this example, would you have drawn Fibo from the top or the bottom? Okay, excellent question. Every time you have an uptrend, you draw it from the bottom to the top. You place the Fibonacci. I am going to walk you through a live, hopefully, if you have time, but you place your mouse over here, click on your left button, and drag it all the way to the top. That is how you draw Fibonacci retracement in an uptrend. In a downtrend is the exact opposite. All right? So I am going to show you afterwards. So as I was saying, when you are in a, let's say the market retraces back up and you actually decide to go bullish on the market after this, like we don't have it in the chart over here, but let's say you see this bullish candlestick over here and you decide the market retracement is over and it's going to go back up. If you do get into a bullish trade, what you can do is that you can basically set your stop order, which is very important and you should always do it, based on one of the Fibonacci levels as well. So let's say you get into a bullish trade right over here at 107.143. You set your limit order at 107.85 and you set your stop loss as in if the market goes against you, you want to get out of the market as fast as possible, right? So you can choose the Fibonacci retracement level as your stop loss level and basically make sure that you're gonna lose more money than necessary, right? So next is, again, John, this can answer your question as well. So using Fibonacci for resistance levels in a downtrend is very similar to the opposite in an uptrend. This time you click on the Fibonacci retracement icon on your trading platform. You place your mouse on the swing high, the top of the chart. You click on your left button and drag your mouse all the way to the swing low, to the lowest point of your downtrend, right? And that is when you see all the Fibonacci retracement levels magically appear. I actually encourage you, if you have your platforms open right now as we are having this webinar, definitely go ahead and give it a try and see if you can make it. So you find the downtrend. Euro dollar is downtrending right now, so that can be a great place. If you go to the daily chart in euro dollar, you can use your Fibonacci retracement, drag it all the way down, and you can see all the levels appearing. And now you can use these levels as resistance levels, barriers that will prevent the market to go further up. So we have this trend coming over here, and we see a little bit of a consolidation with semi-slight bullish sentiment. So for me, as I said before, I would wait for this pivot point, the 23%. I would wait for the prices to break above it to confirm that we are having a minor retracement from a longer term trade. And then I would get into the market around here, set my limit at 1.31 and wait for the market to mature. Some people, if you're a little bit more, you have more risk appetite, you can get into the market right now and wait for the market to get to the 23% Fibonacci level and make a small amount of money over here, which is still fine. But at the same time, you can use this level and this level as your resistance or limit orders, and you can use the bottom of it, obviously, as your support or as your stop loss order if you are in a bullish trade, right? Okay, so do we have any questions, any more questions up to here? All right, so I am going to actually show you how to use these different Fibonacci retracement levels in different time frames. If you give me 1 minute to bring up my Forex platform. Don't worry, you haven't disconnected. I'm still over here. I'm still with you. Okay, so let's go showing my screen. Can everybody see the screen? Okay, so here we have, let's see what we have over here. I have 4-hour charts lined up and the daily charts lined up. This is the euro dollar 4-hour chart. And as you can see, I have actually placed my Fibonacci retracement way before over here. So it's back, I've drawn it back in, from back in February, all the way down to March 16th. And ever since, the market has been moving and moving. It formed a double top, and it has been retracing back and forth, right? So as you can see, I have actually set the 23%. This is the 23% Fibonacci. And I have set it as my pivot point. And as you can see how beautifully it's working. The market is actually testing the 23% and is unable to break above it. So if you ask me what position I will take in the euro dollar pair on a 4-hour chart, I would tell you that I won't take a position as of now because the market is still testing it and it hasn't confirmed a break above it. And if it does, I would certainly go bullish and use the 38% Fibonacci level at 1.08 as my target. But if it fails to break above it, and it's testing, it has tested it a couple of times in the past 2 days. So it seems like this level is actually holding the market, not letting it go further up. But if it does, so if it does, it is kind of testing it right now, right? And by the way, by confirmation, I don't mean just teasing and testing above it. I mean actually confirming and opening above this level the next session. So right now is like literally just teasing this level. So still I wouldn't get into the market. But if you look at the same currency pair in a different time frame, let's say in the daily, now I have a different Fibonacci actually drawn for my daily chart. And I'm in a different kind of trade. You see, my Fibonacci for my daily chart has actually started way back in May 2014, because we have been on a downtrend for euro dollar for such a long time. So what the daily chart does is it basically zooms out and you can see a bigger view of the market. So for a longer term trade, you see, I have been actually waiting for the market to break above this level. Well, this has some other technicality reasons for it. It also has combined with Ichimoku. So here, actually, I have used a different pivot point, not the 23%. Because the longer the time frame, the more expanded the levels are at Fibonacci. So that's why you actually have to use different levels as well as Fibonacci. So here I have the pivot point set at this key level, 1.09 for a longer term trade. And if the pair actually does break above it, I would set my first bullish target at the 23% Fibonacci. Otherwise, I actually did this make this trade. You would wait for the market to go back down and probably reach the 1.04. But the market is a little bit confusing right now because, as you can see, the MACD over here, we did cover the moving averages in the previous webinar. The MACD over here is also giving us mixed signals, and the signal line is basically flattening. So there are no exact direction for the market as of now, but knowing the market and knowing the fundamentals and knowing what the euro and the dollar has been up to, I would say the market is actually going to go back to 1.04, and therefore I am in a bearish trade for this market. So Carlos is asking, can Fibonacci measure RSI or MACD behavior? I'm not sure what you mean by measuring, but I definitely use both of them. So basically, I think you're asking me if we can basically use Fibonacci retracement in a MACD trend, right? So in that case, yes, definitely you can use Fibonacci for those as well. However, I wouldn't do it because so you're basically saying you're having a downtrend with the MACD over here. So you would use Fibonacci to see when the market or where the moving average is going to flatten out. So the reason why I wouldn't use it, you can definitely do it. The reason why I wouldn't do it is because you already have the moving average basically listed on the trend over here. And just by going back and forth in the time frames, you can use the Fibonacci retracement level on the actual prices and use the MACD and other indicators as an indication, right? So I don't want to confuse myself, but you definitely can, and a lot of people do, use Fibonacci on moving averages. Thank you, Carlos, for your question. We have about 5 minutes, so if you have any other questions, I would be happy to answer. In the meantime, I would like to go ahead and show you more of my Fibonacci retracement trading live. So we have, let's take a look. Let's see what is going on in the market. So we have the dollar Swissy pair on the 4-hour chart. Look what's happening. The 23% is holding. Aha, this is great. So I basically draw this Fibonacci retracement from back in March after we had that massive drop in dollar Swissy and dragged it all the way down to here on April 2nd because this seemed like a proper trend for me. So actually, mind you, you can use Fibonacci in so many different ways. So I decided that the trend I'm going to use in the 4-hour chart for dollar Swissy is from here to here. So I decided this is my swing high and this is my swing low. But if you look closely, you actually have a new trend, a new uptrend forming right over here. So don't be afraid to use different Fibonacci levels for like different purposes. I actually did try it. I now remember. I'm going to actually show you how exactly to do it. So I click on the Fibonacci retracement icon over here. Let's say I want to create a new Fibonacci retracement for this small little uptrend that we have over here for a smaller or a shorter term trade. So I drag my mouse all the way to the top, right? And it asks me which levels I want to show. So you can obviously show even more. You can show the 76% as well. I don't want that one, so I'm showing only the 23%, the 38%, the 50%, and the 61%, right? And you click OK, and you have your Fibonacci retracement right over here. So this is a little bit now complicated because I have way too many Fibonacci retracement on one chart. I don't want to get rid of the other one, but hopefully, yeah, John, thank you so much for attending. I saw your message. We are going to actually finish up in 3 minutes as well. So basically, I have this new Fibonacci retracement over here that can help me with a shorter term trade, right? Can you see this one? Okay, it's a little bit too shallow, but let's see what we have here. We have the 61%, which actually falls very closely to the 23% of the major Fibonacci. And we have the 50% that the market is actually trying to break below it right now, right? And we have the 38%. So because the market has actually already broken below this 50% Fibonacci level and approaching the Ichimoku cloud, we could see it going further down to the 60%. So this could be a good time for shorting the dollar Swissy for a short term and aiming the 0.9626 level as an exit strategy. Okay, we are running out of time. I do want to thank everybody. Okay, Bob is asking, do you use Fibonacci extensions for price projections? Yes, of course. I use Fibonacci for price projections at all times, different ones. So I do want to thank everybody for attending. Unfortunately, we didn't have more time today to answer all of your questions. If you do have more questions, please email info@orbex.com or email myself, Kiana@investdiva.com, and hopefully we can answer your questions. If you have any recommendations for upcoming webinars, what you would like us to cover, definitely recommend us as well, and we would be happy to cover your questions during our live webinars. Thank you so much for attending. Trade responsibly, and I will see you in the next webinar.